Analyzing statements of cash flow, part 1. We're going to have an introduction to cash flow statements, followed by a discussion about the linkages between the financial statements, that is your income statement, your balance sheet, and your cash flow statement. Then the cash flow statement consists of three parts: operating activities, cash flows, investing activities, cash flows, and cash flows from financing activities. So we'll be discussing all three of those with a special focus on cash flows from operating activities, because this can be prepared by two methods, the direct method and the indirect method. And we will also look at the way to convert from the indirect to the direct method. And then finally, we will look at the differences in cash flow statements that are prepared under US GAAP and versus IFRS. So naturally, cash flow statements contain very important information, and the reason for that is, and this is something that you're going to appreciate more and more over the course of your 3 levels of CFA studies, is that the valuation of a company's equity, so equity valuation, is based on something called free cash flow to equity, right? And you already know that what we really want is the present value of future cash flows. That is how you come up with a value of a certain asset, right? That what future cash flows it will give you and what is the present value of those future cash flows. And you can only calculate that if you know the future cash flows. And the cash flow statement is what shows you the cash receipts and the payments during an accounting period. And then obviously you can do a projection of that to come up with the future. So this is, of course, very, very important as far as equity valuation is concerned. It is even more important for the short term if you are looking to get into debt financing, right? So if you're not looking to do equity investments, if you're looking to do debt oriented investments, that you're looking to provide a loan to a certain company, or you're looking to buy or invest in the bond of a certain company, then you want to see that what is the level of liquidity that this company has in terms of cash. Can they pay their interest on time or not? What about their solvency? Are they running out of cash in the long term, right? What is the level of their financial flexibility? Are they really, really in over their head with the cash that is coming in from customers is not even enough to cover the interest payments? So this is your cash flow statement, and it is prepared or characterized under 3 sections. One is called cash flows from operating activities, which is obviously related to your operations, your core business operations. The other one is investing activities, and the third one is financing activities. Now, what does each one of them entail? So in your financing activities, you've got, let's say the company is started and there is equity injection, right? Where your shareholders are putting in cash into the company. So this is positive, obviously, because cash is coming in. And let's say you take a loan from a bank. So that is also positive as far as cash is concerned, because cash is coming into the business. If you buy, let's say, land, right? Or if you buy, let's say, some equipment, so these will be negative. These will be negative because cash is going to go out. Maybe you're going to buy some inventory, right? So that will also be negative because cash is going out. And then finally, you might have some sales, right? Which, let's say, results in cash receipts. Cash receipt. Then that is going to be positive and you'll start getting your cash back. Now, a very important concept I want to emphasize over here is that if you sell that piece of land and it is obviously going to be resulting into a positive cash flow, that positive as well is going to be recorded under investing activities. If you pay a dividend, right? If you pay a dividend to your equity holders, that is a negative cash flow, but nevertheless it is a financing activity and it will be recorded under your financing activities. Now there is some difference in US GAAP and IFRS that we will be looking at, such as payment of interest on the loan. Now, with the current logic that I gave you, that if dividend payment is written in equity part, which is financing activity, so therefore payment of interest should also be written under financing activities, and that logic is correct as far as IFRS is concerned. IFRS does allow you to write it under financing activities. However, US GAAP is different over here. US GAAP says payment of interest is a operating activity. However, repayment of a loan where you are paying the principal back, both IFRS and US GAAP agree that it is a financing activity. Alright, anyways, we will look at the differences in US GAAP and IFRS in much more detail towards the end of this learning module. First, let's have a high level basic understanding of the three sections. First being operating activities. This is related to the normal operations of a business, such as cash coming in from your core business, which might be sales or commissions if you're in that kind of business, or royalties if you are, for example, giving out franchises and receiving royalties from those franchises. Cash outflows such as buying of inventory, paying your staff, or paying rent. So that is an example of operating expenses. Now this third one is a little tricky because it could be investing as well. Cash payments and receipts related to trading securities. Well, you might remember from our discussion on the balance sheet that securities could be held for trading, or they could also very well be available for sale, or they could very well be held till maturity. So depending on how frequently you are buying and selling these securities, if they are long-term investments, then they will be in your investing cash flows, right? But if they are short-term investments, and you are a trading company like a hedge fund, for which the core operation is buying and selling these securities, and they are classified as held for trading, then they will be, the cash flow from their buying and selling is going to be shown under operating activities. But naturally, if you're not buying and selling, or rather trading these securities, but you're investing in them for the long run, right, available for sale or definitely for held to maturity, it will be shown in investing activities. What else is there in investing activities? Any other kind of long-term asset that you might be buying or selling. So if you're selling property, plant and equipment, non-current assets, or if you are buying non-current assets, they will be shown under investing activities. And finally, financing activities, getting money from your equity holders, paying money back to your equity holders through dividends, right? Getting money from your debt holders, such as a loan from a bank or bonds, paying money back to them, and this obviously is principal repayment, right? As far as interest is concerned, that is going to be a little bit complicated, because interest payment, as I already told you, and I will tell you again towards the end of this learning module when we cover the IFRS and US GAAP differences, that IFRS allows you to put it under cash flow from financing activities as well as cash flow from operating activities. You can choose, but US GAAP does not give you an option here. It insists that interest paid is cash flow from operating activities, but principal repayment is a financing activity. And issuance is, of course, definitely a financing activity. All right. Now, a very interesting perspective on how your balance sheet, income statement, and cash flow statement are linked, right? So, for example, on your balance sheet, you have assets, you have your liabilities, and you have your equity. And on your income statement, you have your sales, and I'm just going to keep it short, expenses, right? Of course, I know you know by now that your income statement format is much longer than just sales minus expenses is equal to profit. But let's just keep it simple for now. And your cash flow statement is going to be cash flow from operating activities, cash flow from financing activities, and cash flow from, or it's cash flow from investing and then cash flow from financing. Now, let's take some examples. Let's start with sales over here. Sales obviously is going to be related to cash flow from operating activities, but it's not necessary that the entire amount of sales of a company, let's say there was $100 million sales in this year, does that mean there has been $100 million cash received? The answer is no. You have to check something called accounts receivable, right? Because if $100 million sales is there and $100 million increase is recorded in your account receivable, that means none of that sale actually has resulted in any cash. So what we need to see is that the sales should be double checked with the change in account receivable before we can come to the conclusion that how much cash has been received from your sales. Similarly, for your expenses, on the liability side, there is your accounts payable. So if there has been a lot of expenses, but then your accounts payable has gone up, which means you haven't really paid anybody for those expenses, right? So let's say there has been $100 or $80 million of expenses, right? But your accounts payable has gone up by 80 million. So you actually haven't paid anybody for those expenses, and neither have you received any cash. So what we have to see is that what has been the change in your account receivable, what has been the change in your accounts payable. And of course, there are other balance sheet items that we need to carefully check, other income statement items. And this is how your cash flow statement is linked to your balance sheet and income statement. And I will show you with some examples now. So as far as balance sheet is concerned, of course, cash is an asset which is reported on the balance sheet. Now you will have your opening balance for that, right? Let's say we're looking at the balance sheet of a given date. It will show cash balance of, let's say this is 2022 December. 2022 December. The cash balance is $50 million. And then on the balance sheet for as of December 2023, the cash balance is showing $70 million. So how did we get from 50 to 70? Because the closing balance for 2022 is the opening balance for 2023, but then how did you get from 50 to 70? And that is what the cash flow statement shows, that how did you go from 50 to 70. And let's have a look. So let's say there is a simple scenario. Beginning cash was 1,100 and ending cash is 1,000. So how did we get from 1,100 to 1,000? Let's say you got cash of 3,200. So this is money coming in. And you paid 3,300. So this is money going out. So naturally you have paid more than you've received. So 100 is the amount you've paid more. Therefore, your cash went from 1,100 to 1,000, right? So it's very simple and very straightforward actually. But calculation of these receipts and these payments actually is the relatively complicated part, because again, I mean, for receipts, you'll have to check what was the sales amount, and this comes from the income statement, obviously. And then from the balance sheet, you will have to check the change in accounts receivable, right? And then you'll be able to come up with what is the cash receipt. And similarly, for the cash payment, you have to check the change in accounts payable, and also you have to check the cost of sales or the cost of goods sold from your income statement, and accounts payable is obviously from the balance sheet. So these things you have to do, and then you will be able to reconcile your cash amount going from opening to closing. So let's work through it together with another example. And here we're going to be looking at the change in accounts receivable versus the sales, the revenue during the year. That how can you come to the cash collected from customers amount. So let's consider an example of how balance sheet items are related to income statement items. Now, why balance sheet? Because account receivable is from the balance sheet. Why income statement? Because sales or revenue is from income statement. Right? So your beginning account receivable balance is $200, right? The beginning accounts receivable balance is $200. The revenue or the sales during the year is 5,000, right? And cash collected from customers is 4,800. Now, ending accounts receivable balance is going to be 400. Why? Well, because if you have sales of 5,000, but cash collected is only 4,800, that means $200 worth of sale has been done which has not been collected in cash. So this 200 must have been an increase in accounts receivable. So accounts receivable must have increased from 200 to 400, right? And this is how your balance sheet and your income statement and your cash flow statements are linked. So the beginning accounts receivable 200, revenue 5,000, cash collected only 4,800, right? That means the ending receivables will be 400 because sales of 5,000 is 200 more than the cash received of 4,800. So the remaining amount definitely will increase your receivables. Right. So how do we go about preparing your cash flow from operating activities? And before I jump into the indirect and direct method, I just want to emphasize on one thing, that your cash flow statement has, of course, your cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. But there is no change or there is no difference in preparation of cash flow from investing and cash flow from financing. These two methods, which are your indirect method and your direct method, are only there for cash flow for operations, right? So cash flow from operating activities can be prepared either with the indirect method or the direct method. Number one. Number two, the direct method is the one which is encouraged by both IFRS and US GAAP. But the question is, does everybody follow the direct method? The answer is no. The one which many companies, so this is preferred by corporations, preferred by companies. And the reason is, when you are going to actually now see how you can make your cash flow from operating activities using both these methods, you are most likely going to like this one, which is your indirect method, instead of the direct method. Now, what is the difference between these two? In the indirect method, we start with the income, net income, and that comes from your income statement, obviously, right? So the income statement is prepared first and it shows the net income. Balance sheet is obviously prepared as well because you know all the closing balances, and you can compare the balance sheet of the previous period. So let's say this income statement is for the year 2023, right? So what you can do is you can take the balance sheet from 2022 December, and you can take the balance sheet for December 2023, and for this whole period from Jan to December 2022, you can check the changes in the balance sheet accounts such as account receivable, account payable, and you can sort of take your income statement, net income, and make the adjustments to this and come up with your cash flow from operating activities. It is very easy to do, and really a lot of fun to do, because what happens is at the end of this whole thing you are able to reconcile your cash account, that what was my closing cash, which obviously is the opening cash for the next year. So what was my opening cash for 2023 and what was my closing cash for 2023, and does my cash flow statement, especially my CFO and then of course my CFI and my CFF, show the working, that how did I get from this cash to that cash. So indirect method is definitely preferred by the practical accountants who are maintaining and developing these financial statements. But as far as IFRS and GAAP is concerned, they do encourage the direct one, which directly shows what were the specific inflows and outflows, right? Here we're not in the indirect method, we're not showing what were the cash received from customers or what were the cash paid to suppliers. We're just taking the net income and we are making some adjustments. Now let me make it very clear to you what that means, and by showing you a format of an indirect statement. So you start off with a net income. Now here we are not showing anything directly in terms of what was the cash received from customers or what was the cash paid to suppliers or what was the cash paid to employees, nothing like that. This is done indirectly. And how do we do it? And I'm going to explain each one of these points to you separately. Now let's go through it slowly together. First of all, depreciation is a non-cash expense. What does that mean? See, remember what is depreciation? Depreciation was you buying a long-term asset and deciding what is its useful life, and then dividing that expense or that cost of that asset across its useful life, so that the matching principle is kept intact, that whatever useful life of that asset as you are using it and obviously hopefully generating revenues against it, then you are expensing that cost divided across its useful life. But the question is the cash going out or not? So if you bought a plant for equipment for $10 million, and then every year based on a useful life of 10 years you are expensing out 1 million of that cost, is the cash going out every year? The answer is no. The cash has probably gone out in the earlier year, and here this is just a non-cash expense. And even if the cash did go out, let's say this is the first year and 10 million has gone out this year, it will be shown in cash flow from investing activities, because purchase of a long-term equipment is definitely investing activity. So as far as cash flow from operations is concerned, there is no cash impact of depreciation. Depreciation is a non-cash expense and therefore it has to be added back. Why it has to be added back? Because when you booked in your income statement the expense of depreciation, you wrote it down as a negative number. So from your sales, when you were writing your expenses, you reduced your sales amount, and therefore when you came up with your net income, it was already reduced by that depreciation expense amount, but no cash has gone out, so we add this back, right? So the first thing we do in our indirect cash flow from operating activities preparation is that we add back non-cash expenses. That could be depreciation, that could very well also be amortization, which is for intangible assets. Secondly, any kind of gain on equipment or loss on equipment has to be adjusted. Why? Because that is related to investing activities, right? Equipment is a long-term asset. So if you're buying equipment, selling equipment, and you're having a gain or loss on it, then you need to adjust it from here, because you probably added this gain over here. You probably added this gain in your profit, in your income statement. So your net income is showing that gain, but this amount is going to be shown in your investing activities. That is why we are minusing that gain from here. If it was a loss and it had reduced your net income, we would have added it back. Now, increase in accounts receivable is negative. Why? Because if you're having, let's say, sales of 100 million, right? Which obviously has been included in your income statement. So let's say in your net income, which is coming from your income statement, the sales of 100 million is there. But your account receivable has actually gone up by 50 million, right? So that means this sales that you have done, not all the cash has been received for the sales. So you need to adjust that, because even though that sales will be reflecting in your net income, but that doesn't mean the cash has come in for that. So if your account receivable is going up, that means it is money getting stuck up in your customers' receivables, and therefore any increase in accounts receivable is negative. Now this is something you have to understand very, very carefully. Any increase in an asset, right, if that asset is not cash, if it is apart from cash, such as account receivable or inventory, right, prepaid expenses, all of these are assets, and if they are going up, that means your cash is getting stuck up. Either you've supplied goods to your customers and they have yet to pay you, or you have bought inventory and you have not sold it yet, so your money is gotten stuck up in inventory, or you have prepaid for your rental or insurance and your money is gotten stuck up over here. So all of these situations over here that you can see, increase in prepaid expenses, increase in accounts receivable, increase in inventory, they are all assets. All three of these are assets, and increasing of assets is shown negatively on your cash flow from operations. However, when you talk about increasing of liabilities, such as accounts payable going up, means you have got some supplies from your suppliers, but you haven't paid for it. So that means it's a good thing, right? That you did this expense in your income statement, that you got your raw material, it helped you generate this income, probably helped you generate the sales as well, but you haven't paid these suppliers because naturally your accounts payable is going up, which means the amount that you've purchased from them is a lot more than what you've paid to them. Therefore the balance of accounts payable is going up, and this is good as far as cash flow statement is concerned. So you can see that increase in accounts payable is positively shown over here, because this is money you are pulling from your suppliers, and that is true for all these liabilities. That is true for all these liabilities which are going up. You can say accounts payable, wages payable, which is for your salaries, right? Tax payable to the government, any other accrued liabilities like maybe something small, not related to business. So accounts payable is also called trade payables, and that is for your suppliers of your core business products. But other accrued liabilities, such as maybe you bought some stationery for the office, but that also is from a different supplier and that is on credit as well. Or maybe interest to the bank, right? So all of these are liabilities, and when they are going up, increase, the impact is positive. However, if liability is decreasing, that means you paid for it, and cash has gone out. That is why it is shown over here in negative. And then when you reconcile all of that, you are able to generate your cash flow from operations, and clearly it is more than income, which means the increase in liabilities has been more than the increase in assets, or maybe the depreciation expense has been huge, which has been non-cash. So whatever the reason might be, this is how the indirect format is prepared, and it's relatively easy for companies to prepare this. That's why they prefer to just do the indirect format. In the direct format, you have to show exactly what was the cash received from customers, what was the cash paid to suppliers, what was the cash paid to employees for rental or other operating expenses, interest paid, taxes paid, and the answer is the same. Let me just go back and show you 3,200 and 3,200. So the answer is always going to be the same. That even though the presentation formats are different, the answer will always be the same under both methods. And the direct one is encouraged by IFRS and US GAAP. However, majority of your companies are going to be using your indirect format. Right. So how do we go about preparing the direct method? This is again done similarly. Like for example, you will take your sales, right? You will check your change in accounts receivable and other related balance sheet accounts, and then you'll have to reconcile and then check, okay, what was the cash received from customers. So this has to be done through a relatively more complicated manner, right? Whatever are the effects of accrual accounting have to be removed, because if you're showing your sales, let's say 100 million, it's not because 100 million cash has been received. Sales is based on the rules of revenue recognition, which is something we talked about in earlier learning modules. And if the delivery is made, the risk has been transferred, even though the cash might not have been received, the sale would be recorded. So we really need to check the accounts receivable, change in accounts receivable, to tell us whether the cash has come in or not, right? So this is basically what we have to do. We have to check the assets accounts. If they are going up, that means cash is going down, and if they are going down, that means cash is coming in. This is something you just have to remember, that asset going up means cash going down, and liability going up means cash going up. This is, I know, a little bit counterintuitive, because usually the mind would say, hey, asset going up is a good thing, that means cash should be coming in. Well, no, because if your accounts receivable is going up, which is an asset, that means you're supplying to your customers and not receiving cash right now, so your cash impact is negative. Whereas accounts payable is a liability, but if that is going up, that means you're receiving services and goods from your suppliers and not paying them right now, so that is good for your cash. How do we go about making these adjustments? So if we're talking about sales, right, if we're talking about cash collected from customers, you need to obviously look at accounts receivable. And if some customers are paying you advance money, right, and you haven't supplied to them, then you will have another account in your balance sheet within your liabilities. Actually, it is going to be called unearned revenue, and you need to check that as well. And we'll look at an example for that shortly, so it becomes very, very clear to you. We'll also look at an example for cash paid for inputs, where we will take the cost of goods sold and we will look at changes in inventory and accounts payable, right? Because when you buy from your suppliers, your inventory goes up, but if you don't pay them, then your accounts payable goes up as well, right? So we will look at these. For operating expenses, of course, you will look at your income statement, SG&A, selling, general and administrative expenses, and then you look at the change in other accrued liabilities or your asset account, which is your prepaid expenses. Similarly, for interest paid, we will look at the interest payable account from the balance sheet and the interest expense account from your income statement. And for taxes paid, again, tax expense from interest from income statement, and deferred tax asset or liability depending on what is the situation. Have we paid extra tax, then it will be an asset for us. If we have paid less tax and we will have to pay it in the future, then it will be recorded as a liability. Now let's look at this example. So you showed us sales of 10 million, but your account receivable has gone up, which means part of that 10 million you haven't received in cash, and unearned revenue has gone up, which means some cash you have received, but actually the sales has not been recorded for that. So how would you go about calculating the cash collected from customers? So what I would request is, please pause the video here and try to come up with this yourself, and then I will show you the solution. Alright, so it's fairly simple. Out of this 10 million, 2 million cash hasn't been received because your account receivable has gone up, and that is an asset, and an increase in an asset means cash will be negatively adjusted. So we will take that 10 million and we will minus this difference of 4 minus 2, right, which is the change in accounts receivable. Secondly, unearned revenue is a liability, right? This cash has been received, but we haven't recorded in the sales, but it is cash that has come to us. And how much cash has been received? 2 million is the new balance, 1 million is the old balance. So we know this has gone up by 1 million. And of course, because this is a liability, it's going up means cash has got to be positively adjusted. So the answer is going to be 10 minus 2 plus 1, 10 minus 2 plus 1, and that is going to be 9 million. Right, so this was for sales. Now let's have a look at an example for paid to suppliers. So your cost of goods sold has been recorded at 20 million, but your inventory has gone up, right? So they've just directly told you the change instead of telling you the opening and closing balances. And your payable has also gone up. Now payable, my friends, is a liability account. Keep that in mind. And inventory is an asset account. And asset going up is obviously bad for cash. Liability going up is good for cash. Now please reconcile it and tell me what is the cash paid for inputs. Asset going up is minus 4 million and liability going up is plus 2 million. So that will be 22. And that, my friends, is it for the discussion on this video. In the next one, we're going to talk about the indirect method.